Hey D Cruz, how are you? This is Cedar, and we are now live in our Mind Over Matter Psychology of Trading session for this Wednesday. So just sitting back at my desk, looking to see what's been unraveling or not unraveling, as the case may be, holding above the 10 daily moving average. And there's a lot of psychology when you're like paying attention to levels instead of just panic selling, instead of just freaking out about positions. And so I wanted to open that up because we talked this morning a little bit about, how do you manage if you take a loss? Actually, we started this yesterday. If your first trade is a loss, how do you recover from it? What does that look like? So I wanted to talk about losses a little bit. I thought that'd be a good way to kick today off.
Yeah, absolutely. For an example, I guess, like earlier, I stopped out, took a loss on the day, and then I sold, just got broke even, and now I took another loss, and now I don't even have um, my brokers open, so everything is closed currently, and I'm just kind of watching charts, and yeah, I'm just being patient to wait for something that's actually actionable because I did
Yeah.
not see this coming. So I'm just gonna let this play out, and every time we wick back up, we get drugged back down. Every time we wick to the downside, we get brought back up. But it's just a really harsh, harsh swings of things. So I just kind of, whenever I take losses, I just like to just step away for a little bit, reassess before bad comes to worse, and things start rolling downhill from there, right? So you kind of want to avoid that. Look at your week. Don't look at the day. Don't just be like, oh, I'm down today, but are you up on the week? Right? You're still progressing, right? Red days are going to happen. You have to have that mentality for that.
And it really goes back to, are you executing well? So a losing trade executed well still cost money. It's a cost of doing business. A winning trade not executed well, so not stopped where it was supposed to be by following your rules, is a losing trade, even if it was profitable. And it's really important that we're paying attention to execution, not trading our P&Ls. Like critical that we're paying attention to that. So how you're seeing the market is a question you should be asking yourself regularly. Am I seeing the market well? And this is something that like all of my coaching clients have probably tattooed on their forehead, stick it, post-it notes everywhere. It's this phrase: am I doing what's in my best interest? And if you're not seeing the market well, the answer to that question is, if you're still trading, you're not doing what's in your best interest. If you're seeing it well and you're continuing to trade, absolutely keep trading. So rebounding from losses is probably singly the most important thing to focus on, because if you're just revenge trading, if you're just coming back in and going, well, I took a loss, I've got to make some money back, that's when the huge losses start. That's when those drawdowns where you're just like, oh my gosh, I've got to make this up. Once you've taken a loss, you no longer have that money. So you can't say, oh, I lost $1,000 and you're thinking about what your account size was. So let's say you had a $5,000 account and you took a 20% drawdown, which would be a massive drawdown. That tells me you're oversized. Probably covered in a couple of our other mindset sessions and all over the psychology channel. But the idea is we're no longer focused on 5,000. If you lost 1,000, you now have 4,000, and it's your job to defend that capital fiercely. It's your job to make sure that now that 4,000 is traded well, not continuing to throw good money after bad, as Thor always says, one of my favorite sayings. So I wanted to actually kind of focus this on hold on, let me get there. In the psychology channel, I put up a trading success playbook that is, if you're ready to level up your trading game. I posted this on Friday before closing screens on my husband's 50th birthday. And the whole focus of this, trading is not that complicated. You have to figure out how to minimize your losses and let your runners run. So cutting losers, or not being so oversized that you can't give them some room to be able to develop into your trade thesis. And so a couple key pieces you have to keep in play, regardless of how you do your technical analysis. And we all have a little different way. It's what makes a market for sure. And I would say, for for the most part, good TA is good TA, but we arrive at it in different avenues. So for 30 days, I would ask that you commit and take deliberate action. You have to have 100% focus on one defined system. And if you haven't defined your edge, there's a reason this one's first. You have to do that first. If you don't know what your edge is and you're all over the place trying different entry ideas, you're trying different trade setups, and you haven't really found what your edge is, you got to hold off on this for just a little bit and really dig deep. And I think the easiest way to find that is by journaling. So if you're not journaling, that's my first suggestion, is you got to be paying attention to what you've been doing. You could also just open your broker on your desktop. And Cruz talks about this all the time. You can see what your most profitable ticker is. And you probably have a pretty good idea of the things that you've been adding to, that you've been averaging down on, DCAing. Don't do those. But if you know that you've been like, well, yes, I'm profitable on this, but it's because I've been oversized, because once I was in a trade, then I was adding to it and, like had to be right. And eventually I was. That's not your best setup. If you're finding yourself adding over and over again to positions, it's probably not, your trade location is not great. If you notice, I don't add to positions if I'm entering at my full size, which is 3 ES on that $25,000 personal account, or $500 on my 10K options account. I don't go, well, I was wrong, I'm just going to add to that. I'll exit the position. I'll re-enter if the TA hasn't been invalidated, but by also exiting when I'm not sure what's going to happen, I'm managing what my downside risk is. So if you're not oversized, there's always another trade, because you can always just come in and go, okay, I was wrong, 5%. You can take 20 trades in a day if you're taking a 5% position on your account, and 5% is pretty decent sized. The larger your account gets, the closer to 0.5% and 1% you get. So those traders that are trading hundreds of millions of dollars of accounts or account size are not trading 5%. They're trading 0.5%. Those trading a couple $1 million are probably trading 1%. 2% would be considered oversized on a larger account like that. So what you have to be thinking is, as I'm more and more successful in my trading and continue to grow my trading account, I need to be sizing down. And I see that as the opposite of what most new traders do. They're successful, so then they lean into it, size up, and that's when they blow their accounts. It's invariable, like it happens magically, clockwork. And so if we know that, historically, that is what happens. I've never seen it not happen. So I can say all of the time, at some point, once you lean in and size up, you're going to get clapped. Why don't we get ahead of that, use that as a heads up and go, all right, if I'm currently trading 10% and I am profitable, as soon as I get that account up a little bit higher to the next notch, and you need to probably write those down, what levels you're wanting to see accomplished, you're not increasing size when you get there. On my 10K account, when I'm trading that actively, and I am back to trading that definitely now that I've gotten business stuff settled and I'm in my new home gym / trading room, so my office is pretty much set. The floor is down except for one corner. Now that I'm a little more settled, I'll be trading options like I used to. Oops, hold on just a sec. I'll be right back.
Oh, yeah, it's kind of what I was touching up on earlier, is just trading what works for you. And there's plenty of different ways to make money, if you will, in in the market. So that's what's good sometimes, and sometimes it's bad, right? So really got to be patient with finding our strategies and our edge and just what works for us. But once you do find it, you just kind of build on that, just get better and better,
and continue
you
to
stick
add
with-
different strategies.
Yeah.
Yeah. So we define one clear, what you trade really well,
then you expand.
and you trade that until it's so boring that you're like, oh, this is relaxing. Okay, I'm going to go develop a new edge. And that doesn't mean you start trading it with live money. It means you start sim trading, practicing back testing, on developing what your new strategy is to see if it's successful. Because just because one strategy has been successful doesn't mean the new one will be. So you want to make sure you're testing it, and you start adding that to your repertoire of trades that you have for setups. But one setup, and that's why it says one defined system, your edge. If that's one setup, that's my suggestion. If you're newer to trading, or if you're not, and you're not currently profitable consistently, and I don't mean big account swings, I'm talking your up days are larger than your down days. Month over month, you're green and have been for the last, I'm going to go with 12 months. We could say, if you're newer and maybe it's 3 to 6 months, that's an individual threshold. When I define consistently profitable, it's looking at a 12-month rolling average with no red months. Might have red weeks, but you're able to regulate yourself well enough that you can step away and stop trading if you need to, and then come back refreshed, even if that's taking a long weekend or whatever that is. So 100% focus on one defined system, 100% focus on thinking in probabilities, purely probabilities, no hopium. I almost put that, but I wanted to keep it super clean. Probabilities are that whatever your win rate is your probabilities factor. If you are following your rules, if you're following your trade setups that have that. So I have a 72% win rate, or no, 70% win rate here for alerts in bull trades over the last 2 years. I started here October 1st, 2021. And that's actually my win rate over many, many, many years. I think it's back to about 2009 or 8. Before that, I would have some months that were 80% win rates, some months that were like 58, 59. I'd kind of still, even though I was consistently profitable, I still had a variance in what I was experiencing as far as win rate. And to some degree, that was because I was trading a lot of things, a lot of different products that I was not as good at. And the longer I've traded, the more I've just gone, I've been successful trading other things, but how much time and energy do I want to put into this? And if I can be consistently profitable trading 4 or 5 tickers in general, why don't I just focus on those? So I'm specialized in those. When you're newer, when you're not consistently profitable, you need one ticker and one trade setup. And then you can add another ticker with that trade setup as you get to know that ticker's personality. If you are bouncing all over the place, trading different tickers, chasing different analysts' alerts, chances are it's not going to work out well for you. And not to say that we don't have great alerts here. Somehow, and I don't know how, but somehow newer traders have the uncanny ability of selecting our losing trades. Like a heat-seeking missile, select our losing trades. And if we could figure out how to can that and have it not happen, we would also take a little booster shot for it. We don't know which ones. We're working in probabilities. So that's why 100% focus on probabilities is that we're not sized up in anything. There's not more confluence or more thought, oh, this is going to play out better. In the majority of trades that we're taking them based off of probabilities in our defined edge, and cutting them when they have basically the TA has been invalidated, or there's a concern that it could go against us very badly. So the probabilities piece is huge. If you oversize, you can't think in probabilities because you've already blown your account on 1 or 2 or 3 losing trades, or one trade that you continue to add to that didn't start out that way. It was 5%, 10%, now it's 25%, and a quarter of your account's gone on 0-day options. Next one is 100% focus on volume and pure price action. So everything that I track is volume based. Anchored VWAP, so AVWAP, it's anchored volume weight adjusted price. SVP HD, that is the set range volume profile that I use to mark value area high and low. I have previous days of the value area high and low volume point of control and the T+2, so 2 days prior. Everything I do is based on volume and price action. And while my execution charts look crazy, they're expressing what that volume and price action is so that newer traders can see them, instead of me saying, this is this level right here. And it's this enigma that I've seen so many people go, well, why do you see that? Why are you thinking that level is important? And I'm like, well, the 10 daily moving average, we lost it, so I can't go long here, right? Daily moving average, it's a trailing, but it is based on the moving average of what the stock is doing, and it is consistent because of what other traders do in response to it. So I have to be paying attention to what other traders are doing, even though I don't really trade off of the moving averages. What other traders are doing will affect what I'm trading. So that's the reason I use moving averages. Key structures, overnight low and overnight high, that's pure price action. But I don't have a bunch of other stuff that is not involved in volume and pure price action. So if your chart is not leading you the right direction, I would consider maybe re-looking at indicators you're using, maybe going down to a bear chart, especially if you've been trading for a little bit. You might need to declutter it and start back from very basic. So my white candle chart that I use when we do the lunch and learn is my just pure, what's happening in the candle structures. There's not even green and red candles. It's a blue faded to black background and white candles, so that I can just look at what's up there. So if you need to have one of those that is able to let you clear your mind and see where we're potentially headed and where we've been, looking left can be very huge on those. So then the next 100% focus is on risk management, and touch this a lot already, but you have to be managing your risk. You have to be managing your trading account like the business that it is. It is a business. It is not a gambling event. And if it is, you probably won't be here. So if you're here for the thrill, and we saw this discussion a little bit earlier in Market Talk, where somebody said, well, I'm just a gambler. And what Thor said in response to that was, if you must, then you have your regular trading account, and then you make a small account off to the side that you can gamble as entertainment money. Now, I see where he is coming from with that. My issue is perfect practice makes perfect, and imperfect practice does not make perfect. So if you are in the habit of engaging in gambling behaviors in your small account, it's very likely to transfer over to your main account, and very likely in the sense that I don't trade my long-term portfolio the same way I trade my day trading portfolios or my regular trading portfolios. And I keep them separate entirely, so they have different rules. I know my levels of the positions that I'm in. I keep a kind of a loose eye on things, but I don't go in and accidentally trade myself out of them because they're in a separate account. If they were in my trading account, I'd be like, do you know how much Tesla's up since I entered it? It's a lot. Am I trading myself out of it? No, but it's because I don't look at it every day. I go, oh, that's getting past my grandkids, right? It's probably going to be in the portfolio for a very long time. If it were sitting in my trading account that I'm actively popping in and out of things all the time, I'd trade myself out. So my risk management on my long-term investment portfolio is such that I entered them with the understanding that I'm going to hold them 5 to 10 years, at least 3 years, but 5 to 10 and probably 20. So it's a set it and a forget it kind of concept. And if I did that on my regular trading accounts, I wouldn't have regular trading accounts. They'd be gone because I'd be like still sitting in trades with everything blown up. So your risk management has to be based on your individual risk tolerances. How much are you willing to lose? Has to be the very first question you ask yourself when we're talking risk management. If you're not willing to lose every single penny of the trade you have on right now, you have no business in that trade. And I'm not saying you should let it go or it should go there, but if you would wake up tomorrow upset that that trade went to zero, you should not be in the position. That means you're oversized for what your risk tolerances are. And that's a huge, huge thing. Last bullet point there is 0% focus on other people's opinions. Eliminate the social media diet and surround yourself with experienced and consistently profitable active traders. So many people are like following, like 300 accounts on FinTwit. How long have they been short? A long time. Getting clapped, getting clapped. I have a funny post on my X account about shorts if you want to go check that out. The link's in my bio for the X, but it's like shorts. So we'll just leave that there and let the GIF speak for itself. But other people's opinions, and I put that in quotation marks, you don't have any qualifying understanding of those people's trading day in, day out. Are they consistently profitable? Do they know what they're talking about? Because anyone can talk a big talk. And it's the whole thing with social media. You always put your best foot forward, which is different than what we're doing here. We're putting whatever foot we have forward. We're trading live on all day long with full, like, I took this loss, I took this gain. Here's, here were my entry and exit reasons. And it's live with our members. I want you to be really careful of what you're following outside of that, because you don't know, for the most part, who those people are and if they actually, A, are even trading, and B, consistently profitable. And that's a scary prospect, to be letting your business be influenced by somebody that is not maybe what they represent themselves to be. So challenge to you is to journal every single trade. If you trade too much to journal, you're probably trading too much. And underneath that, I put no bullshit, no excuses. You're either consistently profitable or you're not. That's it, right? Proof is in the pudding. So if you're not, you have some stuff to work on. And what's above here will get you where you want to be. So if you're ready to level up your trading game, this is my challenge to you. It's a personal step up your game initiative. We did have some people start with that, but didn't see very much. So I know a lot of you guys are new. Would love to definitely see some more trading accountability posts, and not just when you're profitable, and not just when you're losing, but all the time. If you just like, this is what I do. Every day I recap and I journal and I, write down what I did well, what I traded well, what I didn't, what my game plan is the next time this comes across. I promise it will change your entire trading career in a matter of 30 days. If you're consistent with it, you'll have developed that habit. And then right after that, in risk management, the psychology risk management channel, Tyler posted a GIF or an infographic talking about developing your trading plan. So it actually goes into some more of the technicals. If you want to have a proceduralized written trading plan, it is beautiful. So I am going to, did you have anything, D. Cruz, to add to that little, let's go? A little bit of cheerleading, a little bit of push. We might have lost him. I have to hop off for a phone call. I'm going to go ahead and end the recording here, but I will be back on voice in about 25 to 30 minutes.